All right. Thank you, everybody, for coming. Beautiful evening out there. Great crowd. Really excited about our speakers tonight. For those of you I have never met, let me just give you a quick intro. My name is Steve Bogie, the founder of the Bogie Investment Group. I'm the senior managing director at Marcus & Millichap. Been there for the last 17 years, specializing in the sale of multifamily properties in Southern California. I want to thank my staff and introduce you guys to them quickly here. If you need anything throughout the evening, any of these people will help you, and if we can applaud for them for putting together an awesome event. Mike Kenworthy, our managing director. Mike, over here. Therese, our marketing director. Therese Weed. Gabrielle, transaction coordinator. Where are you, Gabby? She's probably working on a deal right now. And Megan Coffey, our production assistant, who's also probably working on a deal right now. All right, so a lot of you guys were invited by some of the guys on our team, so I want to introduce them to you. If you guys can just, thank you. Actually, you want to do that for me? Stand there. If you guys could just stand up and wave so you can maybe meet some of the people face to face that you, well, I'll introduce you and then you can wave. All right, first, David O'Keefe. Mid-Cities Director, Shane Young, Long Beach Director, Jonathan Weir, South Bay Specialist, Jack Jorgensen, Mid-Cities, Alex Colombo, he's not here tonight, also Mid-Cities, Troy Reese, West Side, and sometimes San Pedro. Mitch Kanata, Long Beach, you can stand up now, Mitch. Ethan Grunstein, USC Student Housing in South LA. Nolan Wild, North Orange County. Philip Metchling, Long Beach. Ari Zine, Long Beach specialist as well. And newest, Daniel Gomez, East LA. Just want to show a quick map of kind of the coverage that we have. Pretty much about 28,000 multifamily properties across this area that I just talked about. North Orange County. The next slide, if you please. This is our transactions in SoCal. We did about 400 transactions, about $700 million. Trading into, in a lot of cases, out of state. Which we've done 47 transactions out of the state of California in about 16 or 17 different states, totaling about $100 million. So far this year, we've closed 51 deals, over $200 million. About 20% of those deals have been out of state, and a lot of those have also been non-apartment buildings, so like triple net lease type properties. The firm so far has closed 4,442 transactions and $21 billion in the first half of this year. We currently have over 3,500 active listings. And if you guys were out there on the tables, there's some books. We have 3 books. If you can go through them if you want, but please leave them here. They're for everyone to look through during the breaks and afterwards. But we have all the properties that Marcus Millichap has listed. 3 of them are for all the net lease properties, and 3 of them are for all of the multifamily properties across the U.S. So you'll see them when you guys go out there. They're on the tables. So tonight, we've got a great cast of people. We're going to have them come up and present one at a time, and then afterwards we will do a Q&A. There's on your table or on your chairs, there's a notepad. If you guys can fill out a question if you have one, we'll pick them up at the halftime, and then when we come back up, we'll go through those questions. The people that we've got speaking tonight, John Seabury, who I'll present here in a second, Julia Eichhoff, and Jeremy Radicelli. Sorry, Jeremy, from Mashkol, and Joni Weir. Joni, there you are. You'll be following us regarding rent control near the end. So to kick us off, I'm going to introduce John Seabury. John is the first vice president and national director at Marcus & Millichap's National Multi-Housing Group. He is based in the Midwest, works from the Chicago office and Indianapolis offices. John's extensive background as a major multifamily specialist spans more than 20 years, 17 of which were with Marcus & Millichap as an agent. Most recently, he was a managing director for Holiday Finiglio Fowler, where he brokered major multifamily properties throughout the Midwest. Prior position to now was with Marcus & Millichap as an agent. So let's please welcome John Seabury.
That was a good intro. That's a good intro. How's it? We got to get that off of the screen. How's everybody doing? I can't stand still, and I can't stand in one spot, so I'm just going to wander aimlessly as I talk. Thank you for the intro, Bogie. My position with Marcus & Millichap is I oversee the multifamily platform across the country. So I am, if you ask me about, the property at 4th and Elm, I'm not going to know anything about it. If you ask me a 30,000-foot perspective, I'm going to know. So I'm kind of a useless generalist, if that makes sense. But what I thought I'd do is just take a little bit of time and take a look. I think it's important to always, real estate investing is interesting because you become very myopically focused. You get to know your market, your sub-market, your neighborhood, your part of the city. And I think it's always important to know what the national perspective is, what the kind of the headwinds are, and how things are being influenced. So what I'm going to do is go through some of the economic factors that we're following and some of the things that we see influencing the multifamily market from that 30,000-foot perspective. And then towards the end, I'll drill down a little bit into some of the things we're seeing happening in Southern California. We've got a small group. I mean, if you have a question, shout it out. As long as it's an easy question. I mean, don't ask anything hard. Big perspective, macro. When we look at the economy, we look at what's going on. What this chart is showing is just GDP growth and consumer confidence. And I'm gonna bounce through these pretty quickly. But the interesting part of this is, first of all, you look at consumer confidence. That's an amazing trend. That is phenomenal. I mean, that has been on a very, very strong upward trend for quite some time. You can see we hit kind of like 2014, we hit a flat spot. And if you go back, that was during the election cycle. And it wasn't, most of that was a result of there was just uncertainty with the upcoming election. So consumer confidence kind of slowed. And then once that was over, it continued. I'm not necessarily saying it continued because of who was elected. I think it's just the fact that the election was over and the uncertainty was removed. But since that time, consumer confidence has actually gone from about 100 to right now 133 on a scale where baseline is 70, which is phenomenal. GDP growth what's interesting is if you look back, this GDP growth has been very consistent. A little bit anemic, but it's been very consistent. And it's continuing to push up a little bit. It will be interesting to see how long this continues. Obviously, that's a lot of discussion we're having right now. It's jumping up a little bit this year, in large part a result of the tax reform that was implemented in the first part of the year. And then there's a lot of discussion, how long will that take us? How much will that go through? And there's also a lot of what was done with tax reform really hasn't even worked its way into the system yet. So would not be surprised if we see this go for another year or so. The true tailwind that has been pushing this economic cycle has been job growth. Bar none, it has been job growth. So what you see here is, just to give it perspective, we lost 8.7 million jobs in the recession. Since then, we've gained 19.6. So we're 11 million more jobs than prior to the recession. That's a lot of jobs. I mean, that is an enormous number. And from a consistency standpoint, we've been averaging about 200,000 jobs a month. Now, you've got to realize when you are watching the news, if you're a little bit of a news junkie like I am. I'm kind of a news junkie, except then I get ticked off and I say I'm never going to watch it again. And then like 2 days later, I have to go back and watch it. But 2 days before the job numbers come out, every month, they're all talking about it, right? Are they going to be a little bit higher? Are they going to be a little bit lower? And then if they're a little bit higher, they bring on an economist, and the economist says it's rainbows and puppy dogs forever, it's fantastic. And if it's a little bit lower, they bring on a different economist that says, yes, now is the beginning of the recession. What you have to keep in mind as you're watching that is you can't judge it by 1 month. It's going to fluctuate. It's going to go up and down month to month, right? You've got to look at the trend. You've got to take a step back and look at 3 or 4 months at a time and kind of see the direction it's going. But it has continued to be very, very strong. Now, I think 2015 we had 2.7 million new jobs, 2016 2.2, and then we've dropped a little bit in 2017, and what has happened is now we're coming back up, which is very interesting, especially this late in the cycle for that to be trending up. So continuing to be very strong. Unemployment currently at 3.9, is that right? I think it dropped to 3.7 and then back up to 3.9. So continues to be the tailwind that is really fueling what is happening in our economy. When we look at where these jobs are being generated, it's kind of what you would expect. You've got Dallas-Fort Worth at the top, Houston. Keep in mind, a couple of years ago, Houston had lost jobs because of what had happened in the oil business. And they have rebounded at a tremendous rate, very impressive. Seattle, DC, Inland Empire, 50,000 new jobs. Inland Empire, that's pretty impressive. The other thing that I'm always looking at is what's the percentage? So the percentage growth in the United States is 1.6%. And then look at a couple of these are pretty high. I mean, you've got Seattle at 3.6%, Orlando at 4.3%, Inland Empire at 3.4%. By comparison, LA's at about 1.1%, Orange County 1.1%, and San Diego 1.4%. So San Diego's about where the average is. The other one's just a little bit below that. On the right side of the screen are the markets with the least number of new jobs over the past 12 months. And if you take a step back and look at that, what you've got is I think 4 or 5 of them are in the Midwest, a couple of them in Southeast Florida. It's interesting, Cleveland was on the right side of the list, but now that LeBron left, they seem to be doing a lot better. Thanks, Kai. I paid her $10 to laugh at my jokes. So what this is showing is total number of multifamily completions, and then kind of where the vacancy rate is. And what's interesting is that number has continued to go up. So we're going to deliver about 330,000 new multifamily units in the market this year. Last year was about 315,000, about 300,000 the year before. So it's continuing to move up. It's actually kind of interesting because in about the second quarter of 2016, a lot of the lenders kind of started pulling back from a new construction standpoint. They started requiring a lot more equity going into new construction deals. And we were kind of projecting what was going to happen is maybe that construction might drop off a little bit. There's so much liquidity in the marketplace right now. The developers that I'm talking to that are doing larger projects, they're raising a little bit more money. They're putting additional equity into those deals in order for those to pencil out and in order for those to move forward. So it's continued. That has continued to trend upward. Vacancy, it's really not moving. It's about 5.2% nationally. Now, one of the questions a lot of people have is, are there markets where you've got a high vacancy on new construction? And there are. There's a few of the soft markets out there where they're delivering a lot of units in a short period of time. They're getting out over their skis just a little bit. But for the most part, the markets are doing very well. And for the most part, the occupancy rates are doing very well. Denver, a little bit soft downtown. Austin, a little bit soft downtown. Chicago has a lot of new units coming online in the downtown River North area. So there's a little bit of a question of is that going to continue to be soft? But what you got to realize is as long as we have the job growth, if you have some softness, it's not blood in the streets. It just means they got a little bit ahead of themselves, and it'll take a little bit longer to absorb those units. When we look at where the units are being delivered, similar to where the jobs are being created, Dallas, Fort Worth, you've got New York, Denver, Houston, DC. I'm always looking at the percentage. So what this percentage represents is the number of new units that are being delivered. What percentage of the existing stock does that represent? right? So what this, on average, the new units that we will deliver this year equal about 1.9% of the existing stock. Dallas, Fort Worth, 3.3%. Denver, 5%. Austin, 3.5%. Those are kind of big numbers. And that's, you kind of have to take that in perspective a little bit. You see Los Angeles there at 8,300 units, but Los Angeles is such a huge market, it's only 0.8%, right? And then we've got Orange County, about 3,500 units, and San Diego, about 4,100 units, 1.5, 1.3. So below the average, but kind of in the range. On the right side, we see the markets with the least number of new units being delivered. At the top of it, Inland Empire. Anybody remember how many jobs are being generated in Inland Empire? Right? It's like 50,000? Yeah, those are going to be some really packed apartments, aren't they? Inland Empire for the last couple of years has had an enormous amount of job growth and just no new units coming online. Oakland, other California markets, Oakland, Sacramento, and then again, a lot of the Midwest. The Midwest cities just aren't growing as near the rate that a lot of the coastal cities are. So they're not hurting. They're just. I'm from the Midwest. We're a little slow. Takes us a little while. You guys can laugh at that, by the way. So this is an interesting perspective. One of the things, anytime you're looking at multifamily, you have to also look at single family. And you have to understand the relation of the single family to the multifamily, because what they both represent are dwelling units, right? And they're options for people. You have an option of a home or an apartment, for most people. So when the housing market really picks up, that's going to affect the apartment market a little bit. So what's interesting is the solid line is the amount that the single-family housing market contributed to GDP on an average basis, which over the long term has averaged about 4.5%. The shaded areas are recessionary periods. Okay? So look at what happened to that solid line following previous recessions. We've got a recession that ends in 1982 and it jumps, I got it. We got a recession that ends in 1982 and it jumps up to about 6.5%. We got a recession that ends in 91 and it's about 5.5, 5.6%. The recession that ends in 01, it jumps up to about 6.4%. And all that within about 2 or 3 years after the recession, right? Because what happens, a recession, historically, that building boom is one of the things that has pulled us out of that recession, right? We are 8 years since the end of the Great Recession. It's at 3.3%. So the single-family home market just is not, it is not picked up where it had been. And there's several reasons for that. If I was going to break down the three primary reasons, one of the reasons is because of banking regulations and a lot of the changes to the laws and the capital requirements and so forth, Dodd-Frank, you could roll all that in there. It is extremely difficult for lenders to go out and fund the developer that's going to build a large subdivision, especially in the starter home level. The second part of it is, if they do build the homes, it's so much more difficult for people to qualify for the starter homes. And then the third part of it is a little bit more from a social standpoint, which is after the recession, people are much less likely to want to go buy that home, right? And you bake on top of that just the cost increases that we've experienced and so forth. It's become very difficult. The benefit of that to everybody in the room is that as a result, people are staying in apartments a lot longer, right? And people even that can't afford to move out of apartments are choosing to stay into apartments a lot longer. This is probably one of the most important perspectives to look at. So what this shows is the solid blue line are the number of single-family dwelling units delivered to the market each year. The orange are multifamily units delivered to the market each year, and the solid line is household growth. Now, household growth is probably one of the most important factors to really monitor. It's also one of the most difficult to really monitor because household growth will follow job growth, but it doesn't match it one-to-one. Because what happens is you don't get a job and the next day go out and move into an apartment, right? You're saving up a little bit of your money and you're waiting for a little bit of a change. The other thing that happens is, you come out of college and 4 girls out of college decide to rent a 2-bedroom apartment. And then after a year or two, they decide, okay, you know what? 2 of us are going to go rent an apartment here, and 2 of us are going to go rent an apartment here. Well, a household has been created, right? But nobody got a new job. So there's a part of that. It's an expansion of the households that currently exist. So you can see what has happened is that dropped so much in the recession, and then it's continued to come back. It leveled off a little bit, and then it's continued to come up. But there's a couple of interesting points on this. So I ran some numbers, and I looked at 2004, 5, and 6, and I compared it against 2017, 18, and 19. So in 2004, 5, and 6, the number of new dwelling units that were represented by multifamily was about 9%. So 9% of all of the new dwelling units delivered were multifamily. Also, in those 3 years, we were averaging delivering 546,000 more dwelling units than we had household growth, right? So it didn't take long to figure out how the housing crash, what contributed to that. But what's interesting is, if I look at 17, 18, and 19, our household growth is a little bit, right, from an average, and it's going up. But from an average on those 3 years, it's about 3% or about 5% less than what it was in the other 3 years. But we're delivering 76,000 less dwelling units than we have household growth on average over that 3-year period. So even with all the new construction that's taking place, we're not keeping up with demand. The other part of it is the amount of new dwelling units that are represented by multifamily units is about 27%, 28%. So we're 3 times the percentage of new dwelling units that are apartments today compared to where we were before, which is kind of an interesting perspective. One of the things that is happening as a result of this, and kind of the last 2 slides, is that all of the new dwelling units that are being built are Class A. And really all of the single-family home construction. I have music. This is so cool. You got so many things going on here. But you've got one of the things that's happening is you have household growth this year will be about 1.5 million new households. And what we talked about is you're probably going to have about 1.43 new dwelling units that are created. The problem is, how many of those new households can afford those new dwelling units, right? It's kind of a small percentage. So what ends up happening is people are staying in B and C quality product for a lot longer period of time. And you know the old joke, you know how to build a C-grade apartment complex. You build an A and wait 40 years, right? You can't really build a C right now. Now, there's a way to do it with Section 42 and some of the tax credits, but it's very, very difficult to build a property that's going to, especially in California, because in California, LA and San Francisco, 35 to 40% of the total cost is in soft costs and in legal and hookup fees and utility fees and zoning and so forth, which is so much more than other parts of the country. But what this shows is long-term vacancy rates for Class A and Class C product. And it's a very interesting perspective because you can see they're running parallel, and then in 2016 they become inverted. So if we go back to 2013, Class C was about 7% vacancy. Class A was about 4.5%. We go to 2018, and Class A is up to 5.2%, Class C is down to 4.3%. Because what's happening is all of these new units that are being delivered are all on that high end. So they're satisfying that rate on the high end. And I would say our vacancy rate on Class A is probably a bit higher than the 5.2 because a lot of those new properties are giving concessions that are not really coming through in their physical vacancy. Whereas the 4.3 for Class C product, I mean, that's a really, really tight market. Think about that, going from 7% down to 4.3 in that period of time. And once again, it's because the number of households are increasing, but the supply is not increasing. One of the interesting discussions that I have with people is when they're looking at where the market is now and from a transaction velocity. And they're saying, not nearly as many deals being sold today as there were a few years ago. And if you dig into it, what you find out is that 2015 was the peak. It dropped a little bit in 2016. From 15 to today, it's really going off by a couple of percentage points. For the most part, velocity has stayed the same, which is really interesting because usually what happens is if velocity starts to drop a little bit, it's dropping a little bit as a result of diminishing fundamentals. Whereas here, we don't have diminishing fundamentals. We just have very strong fundamentals and less people are deciding to sell, right? Which once again is kind of an interesting dynamic. But what has happened is because we've had such a long run of a positive market, there's so many more investors in the marketplace. So even though it feels like there are less deals happening, the reality is if you look at the numbers, the number of transactions really isn't off that much. And and this is a national perspective. You know, what's interesting is if you look into it, San Francisco and New York both have dropped, whereas LA and Chicago have both increased a little bit. But for the most part, across the board, the number of transactions is about the same. It's just that it's so much more competitive. There's so many more investors. The other interesting aspect of it is where these deals are taking place. So what this looks at is the total number of properties over $10 million. So over $10 million that have sold in secondary and tertiary market, or $15 million. Sorry about that. And then the percentage, the red line is the percentage of all the deals that took place that were in those secondary and tertiary markets. So if you go back and look in 2010, 2011, about 38% of all of the larger transactions, over $15 million, were in secondary and tertiary markets. And where we are in 2018, it's almost 60%, 55%. Which is an interesting, and part of the reason for that is people are just chasing yield, right? You're going out and you're looking for deals. A lot of it is syndicator money. You're raising the money, and then you're going out and saying, where am I going to be able to get the return? And you keep going farther and farther away from the primary market until you can find that return that's going to satisfy those investors. So an interesting dynamic that we're watching. It'll be interesting to see how this plays out, but I wanted to show it as just a little bit of a new perspective. So we've seen this amazing over the past 20 years, really pretty much the last 20 years, we've seen this amazing shift into the city, right? This urban living. And I'm just going to look at the three bars on the right, but what this shows is the household growth, the percentage of household growth that is in the suburbs, in the urban area, and in the rural areas. So it's interesting, you can look at the 2000 to 2010, about 77% of all the new households were in the suburbs and only 8% were in the city. And then you go 2010, 2015, and 21% of all the new households were in the urban core, were in the city, which is pretty impressive. I mean, that's a big shift from an economic standpoint, from a demographic standpoint. And then you look at 2015, 2025, which a lot of that is just projection. But the thought is we're probably going to see, and we're already seeing it, a little bit more growth in the suburbs and a little bit less growth in the city, but still more historically than where we've been in the past, right? And then if you look at the top, nobody's living out in the country anymore. So, but that's an interesting perspective. And then taking that and going kind of the next level, and this is talking about the same thing, just looking at it from a different perspective. And I'm going to bounce back and forth between the left and the right, but on the left-hand side, what you see is the total population. So the one before was talking about household growth. This is just talking about population. And from 2000 to 2010, the percentage growth of downtown and suburban populations, okay? So 2000, 2010, it was 4% growth and then like twice that much in the suburbs. And then if you go to the right-hand side, the portion of that is young adult population is much more of the young adult population is moving into the downtown area, right? So the downtown area is not growing as much, but a lot of the younger people are moving into the downtown. Now, if you look at the middle part of the chart, what you've got is the population 2010, 2017. All of a sudden, the downtown areas are growing at a faster rate than the suburbs, which hasn't happened in a couple of generations. But they're still pretty close. And if you look over the right-hand side, the young adult population is kind of evenly mixed. About the same number going to the suburbs as the downtown. Now look at the right side. 2017 to 2022. Again, a lot of this is projection, but now all of a sudden the downtown population it's going to continue to grow at 0.5%, but the suburban population is going to grow at twice that amount. And even more surprising, the young adult population is actually expected to decrease in the urban areas, right? So that young couple that swore they were going to be city dwellers forever, ride their bikes to work, and only shop at the farmer's market, they now have a nice little fenced-in backyard, a Volvo station wagon in the garage, and a Costco membership, right? So but now, I've had a couple of people that have looked at this and said, well, wait a minute, now do we have a problem? Are people going to be leaving the cities? No, absolutely not. The cities are going to continue to grow. That part of it is not going to change. And the interesting dynamic that I don't think we anticipated, 5 or 6 or 7 years, well, maybe 10 years ago as much, is the number of empty nesters that are now selling their house in the suburbs and moving back downtown, right? And that's continuing to stimulate the downtown areas. So just kind of an interesting perspective on things. Looking at Southern California and some of the things we're looking at, and what we've done is we divide this. We've got Los Angeles, Orange County, Inland Empire, San Diego. That's our metric for Southern California. But when we look at employment growth, once again, national average 1.6%, and for the most part, I mean, Southern California is kind of right in there. It's continuing to do well from a job growth standpoint. You've got Orange County, which dropped off quite a bit, 0.6%. But in Inland Empire, once again, back to Inland Empire. I've been there, not impressed. I don't know. But it's interesting how that area has continued to grow. So you got about 143,000 new jobs that are going to be generated in 2018 just in Southern California, which is pretty interesting. I always show this chart from a national standpoint, and then everybody wants to know what it looks like, in their local market. So you've got Class A and Class C vacancy rates. What's interesting is the inversion of the two lines happened quicker or sooner in Southern California. It happened in really more like 2012, 2013 instead of 2016. The other part of it is, 2012, 2016, it was about 4.5%. And since then, Class A vacancies have stayed about the same. And I'd say, once again, they're probably a little bit higher just because you've got some concessions in there. The Class Cs in Southern California are down at 2.3, 2.4%. I mean, incredibly low. So that's a very interesting dynamic, in which, by the way, I've got to go off on my little Prop 10 tangent, because the problem is, and I'm not telling, this is an easy crowd because you guys are have the same perspective I do, which involves common sense. I mean, we've got, the problem in Southern California is they're not building enough units. And they're not building enough affordable units. And they can't build enough affordable units because the state of California makes it so difficult to build anything, and it takes so long, and as a result, the cost is that much higher. So National Multifamily Housing Council did a study about 5 months ago, and it's a very impressive, very in-depth, very impressive study. But basically what they did is they looked at construction costs throughout different parts of the country. So to give you a snippet of it, they did an analysis of like a 180-unit apartment building in Texas versus doing a 180-unit apartment, the exact same apartment building in San Francisco, right? And what happens is that a load of lumber costs a load of lumber, right? I mean, it does. It's not going to cost that much more. It's all coming from the same forest somewhere. The property in San Francisco ended up costing 40% more. And it was with the same materials. But the problem is that it takes so much longer to build. You have to deal with everything from, the neighbors to CEQA to, 3 years to get your building permits to, union labor to everything else. And as a result of all of that, you have to charge more rents, right? So and I've kind of been leading the charge for Marcus and Millichap on the no to Prop 10, but what they are proposing is, and I don't want to take your thunder, but sorry, you got me going on this, but it is what the state of California needs to do to fix the problem is they need to wipe out some of these barriers so the developers can go out and build build at a lower cost so that middle-class families can afford to rent. So I should probably drop the mic and leave now. But one of the things that we look at when it comes to affordability is what we refer to as an affordability gap. So this is the cost of renting versus owning in different cities. And what we have is a list of the 10 cities with the largest affordability gap, meaning it's the biggest jump between renting and owning. And what you're going to see is that California is, I think, 6 of the 10, and Southern California is 3 of the 10. So Manhattan is at the top, right? But then after that, San Jose, San Francisco, Orange County, Oakland, San Diego, Los Angeles. You've got Seattle, Denver, and Austin in there as well. Now, it's an interesting dynamic, and these are all very expensive cities to live in, but it's interesting that 6 of the 10 are California. I mean, that says something. The other part of it is, there's a part of that that's a little bit of a benefit for the apartment owner, right? Because if you own apartments in this market right now, what this does is it means that it makes it that much more difficult for your tenants to move out and buy a single-family home. So there's a positive aspect of it as well, but that's just kind of an interesting dynamic. We talked about transaction velocity before. I know that anytime I talk about the national transaction velocity, I have to show the local, because everybody locally in every single city in the entire country is totally convinced that their velocity has dropped. So I thought I'd show you guys that yours hasn't. But you can see what's happened is number of transactions, LA, Orange County, Inland Empire, San Diego, really the last few years, it's been very consistent. It's been about the same. And again, there's a lot more competition. There's a lot more buyers out there. They're pushing up values a little bit, but for the most part, it's been very consistent. So I thought that was kind of an interesting dynamic. Effective rent growth. You continue to have very, very good rent growth in Southern California. And a lot of that it goes back to the construction issue. It's very difficult to build more units. Nationally, you've had about 3.1% rent growth, and you can see across there. Inland Empire, 6.4%. Wonder why that is. Maybe it's the 50,000 people that are looking for a place to live. San Diego, 5.3%. LA, 3.9%. Orange County, 3.7%. So, but very good rent growth numbers. Very, very solid rent growth numbers for this market. Number of new completions. Southern California has had decent construction. It's just not nearly where it needs to be. But over the past couple of years, it's been about I think 2016 about 20,000. 2018 is going to be about 17,500 new units that are going to be delivered. But again, 17,500 units and 143,000 new jobs, right? So that means every new unit's going to have 8 people in it. I mean, that part of it doesn't really line up, because where else are they going to live? Because we've only got 2.3% vacancy in the C-grade product, right? So those are some of the dynamics and some of the pressures that we see taking place. Lastly, what this is showing is long-term cap rate trends for preferred primary, secondary, and tertiary markets. Okay, so your preferred markets are going to be, New York, DC, Boston, Los Angeles, San Diego, and then you can kind of go from there. But what's interesting on this, and the point of it that I want to make, is that you can see we go into the recession, cap rates on everything go up, and then immediately in the preferred and primary markets they drop down quite a bit, right? And then it takes a little bit longer for the secondary and tertiary markets to really kind of start dropping down. And in 2011, there's about a 370 basis point spread or delta between that preferred and tertiary market, whereas in 2018, it's gone from 370 down to 190 basis point delta, right? So that continues to compress, but it's not moving nearly as much in the preferred markets and the primary markets as it is in the secondary and tertiary. So what's happening is those secondary and tertiary markets are continuing to improve and continuing to do better. So the point that I want to make on this is that a lot of people are always asking me, hey, where is it happened to me yesterday, where's a really good place to buy? Like I'm going to go, okay, listen, come here, right? You go over there, you talk to Eddie, he knows a place, right? There's a special land of 9 caps, right? It doesn't exist. There is no wonderful, magnificent place left. But what's happening is that instead of looking at this chart in this perspective from a national scale, look at it from an LA standpoint. Look at it from your entire metro and say, what are the primary, secondary, and tertiary submarkets within LA? And what's a tertiary submarket that maybe 3 years ago I didn't feel comfortable really investing in? And going back and taking a look at that, what you're going to find, not in every one, but some of those, you're going to find, you know what, there's a Starbucks on the corner. There's a little bit of new construction happening. There's a little bit changing, right? So when people ask me where is the opportunity, I think a lot of that opportunity is some of those infill areas. And just getting out and looking at areas that maybe you've taken a pass on over the past couple of years, you're going to see some changes in those. Lastly, I get the question a lot about the 10-year Treasury. It was about, I don't know if it closed above 3 today. I know it was above 3 for a good part of the day. And so what's that going to do to cap rates? Hey, the Treasury's going up. I guess cap rates are going up. Probably not. Because what's happening is there's so much money in the market chasing deals that delta is just going to get compressed. Your yields are probably going to become compressed a little bit more. And they're going to become compressed because the fundamentals of multifamily continue to be very, very strong. And what do I think the 10-year is going to do? I don't know. I mean, I've been wrong on that every year for the last 5 years. So I can tell you, but I wouldn't bet any money on it. But it appears to be moving up. The Fed's probably going to continue to raise the short-term rate. There's been so much pressure, downward pressure on that 10-year, which is why it hasn't raised up as much. There's a question: is Powell going to push for an inverted yield curve? A lot of people think he probably will, and take the chance that it won't cause a recession. So we'll have to see how that plays out. But I think that 10-year is probably going to continue to go up a little bit. I don't think it's going to go up a ton. I think it's going to go up a little bit. But as it does, your cap rates are not going to go up 1-to-1. It might put a little bit of upward pressure on it, but what's going to happen is because the fundamentals of multifamily are so strong, you're probably just going to be dealt with a little bit less return on the front end from where it was before. So I guess in summary, I take a step back. I look at, nationally, obviously I'm pretty optimistic about things. Job growth continues to be very good. Our economy continues to do very well. GDP is very strong. Enormous amount of capital in the marketplace. The United States globally is doing better than just about any other major power in the world. I mean, the EU is a little bit of a mess right now. They're not sure what they're going to do with Greece. They don't know what they're going to do with Italy. The Southern American major economies are struggling quite a bit. China's GDP growth is dropping quite a bit. Russia has the GDP of I don't know, like Georgia or something, so that's not going to affect us. But thank you, Kai. Another $10. So but as a result of that, our economy is continuing to do very well. And on a multifamily side of it, we've got a lot of very good things happening, and we've got a lot of construction, but we've got so much demand. We've got so much demand. And that household growth number continues to go, and those people have got to find a place to live, which is great for everybody in this room. And Southern California, I look at it, I mean, the fundamentals of Southern California are amazing. I look in the Midwest, we don't have views like, what you guys have out here in the Midwest. But the Prop 10 thing is a little bit of a little bit. The one thing I'll say about that is keeping it in perspective. Currently, I think there's 482 municipalities in the state of California. Every one of them has the ability to have rent control right now. I think only 12 or 13 of them actually have rent control. So I don't think it's going to be one of those that if it gets passed, which I hope it doesn't, if it gets passed, I don't think it changes the world immediately. But it certainly sets the stage a little bit. But once again, overall, from an economic standpoint, apartments continue to be very good. So any questions? Any thoughts? Thank you guys very much. Sorry. Yeah. Wait. I had one question.
When on that last slide where you had, you see the 10-year going up, and you don't think the apartment cap rate is going to maybe a little bit of upward pressure, but maybe stay stable. What about for other product types? What are you seeing? What do you think is going to happen there as the 10-year?
I think most other product types, it's going to be similar. I'm not as well versed in the other product types. But the fundamentals, retail, certain types of retail are doing extremely well. Office is doing very well. Industrial has been doing fantastic. So I think a lot of that's going to be similar because, once again, the fundamentals of real estate are very, very good. So, all right. Thank you very much.
Thank you, John and Kai. If you keep laughing at those jokes, we'll have dinner. Very nice dinner tonight, I think. $10 a pop. All right, so our next speaker from Mashkol Property Management. Let me get my sheet out here. Jeremy Radicelli. Got it right. He joined Mashkol in March of 2017. He brought with him over 20 years of regional supervisory experience. After 10 years of overseeing dementia and Alzheimer's healthcare facilities, Jeremy spent the last 10 years as regional property supervisor overseeing large rental portfolios of over 3,000 units in Southern California. Jeremy specializes in the repositioning of struggling and distressed assets with an over 20% average increase in NOI. His hands-on experience in the oversight of large multi-million-dollar construction projects gives him the expertise to help owners maximize profits by spending their money the right way and in the right places. Please welcome Jeremy.
Hello. All right, thank you. Check. Can you hear me? All right. So I have no idea what it looks like from 30,000 feet. Mashkol Property Management, we're kind of down on the ground. You guys buy the properties and we make them work for you. A little bit about Mashkol. Oh, this isn't going step by step? That's okay. So one of the things that makes Mashkol really unique, I don't know, I love this business because it's a people business. You come at it from the high level and everybody's talking monies and numbers, but at the end, these are people's lives. And we have the opportunity to affect them and to change them. We're led by Craig and Joel. Craig Senya, Joel Zide. Craig's the back house kind of guy. Joel, I don't know if you've ever met him, but the moment I met him, I knew my life was going to change. And a year and a half later, I haven't looked back. One of the things Joel has done is created an employee culture where we did an employee survey about 6 months ago. On a scale of 1 to 6, employee satisfaction was 5.6, which, in any place I've ever worked for, and I'm almost 50 years old, I've never seen anything like it. So if you have happy employees, you have productive employees. I like where I work. I work harder for Joel than I have for anybody else in my entire life. I'm not going to go into too much detail. I could talk all night on that. Mashkol was formed in 2004. We've got about 250 apartment communities, 6,000 total units. When I started a year and a half ago, that was about 4,000 units. A few years prior to that, it was about 2,000 units from what I heard. So one of the things I love about Mashkol is it's growing. We adapt, they change. Right now we're starting Rent Cafe for our entire portfolio. They're not afraid to jump in and do something different and adapt to what we need to do. Joel and Mashkol have overseen construction projects from about $500,000 to $10 million. We do renovations from $250,000 per unit up to about $30,000 per unit. We'll get a little more into that later. One of the things I found after coming in from healthcare into property management, I thought it was going to be really easy. It's a lot more complicated than it looks. Back in the day, it used to be you just popped a body at a building and that was good enough. That doesn't work anymore. You have to do something different. So prior to me coming on board, they came up with the Mashkol method, which all 5 of these things put together really are a formula to success. I'm going to kind of bounce around a little bit, but each one of these things, if you're missing one, it messes up the equation and things aren't going to be too successful. Pricing in the market, if we haven't evaluated the market properly and figured out what the right rent is, then we're not going to advertise to your right target market. Then if you have a great rent ready, but your price is off, you're not going to rent. If you have a beautiful rent ready, but your curb appeal looks like crap, no one's going to walk into the apartment. You put all these things together, and then you add staffing, which is the key. The key is the people. You can have a beautiful property and an amazing looking rent ready unit, but if they walk in to rent the unit and they do not trust the manager, they are not going to rent. If you don't trust me, you're not going to work for me. And it makes a huge difference. I've seen owners over the years, let's save a couple $100 and just pop a body over here. In the end, you lose thousands of dollars that way. You put the right people in the right places, and things happen. Repositioning versus cash flow. So normally by the time a property comes to us, owners have a plan in mind. I don't know how many of you have worked with Mashcole on purchasing a property and due diligence. But one of the things Mashcole does that I've never seen anybody do before is we bring in all of the trades to do your due diligence inspections. Your plumbers, your electricians, your roofers, your termite. We come in and we walk every single unit one by one, write up a nice little report for you, so before you sign on the dotted line and buy that property, you know exactly what that property is going to need when it closes escrow. You know exactly how much you're going to have to spend, so that by the time it closes escrow, you've got a plan and you know what you want to do with your property. Usually people come somewhere in between the two. They're either going to reposition it so they can sell in a few years, or they're going to hold on to it for a while. Repositioning, generally speaking, we're going to come in and we're going to take your C property, turn it into a B property. Take your B property, turn it into an A property. We're going to add value. We're going to capture higher than market rents. We're going to bring in qualified residents. Back in the day, you just wanted to fill in a body. The wrong resident can cost you thousands of dollars. It makes a lot more sense to vet those people properly and put the right residents in. And our bottom line is to raise the rents in your NOI. That way, we're adding value to the property, and I'll get into a little more detail on this in a few minutes. Another fun one, I like these the best, are the distressed properties, where you find that property that's been neglected, that has a high vacancy factor, that has a crap load of deferred maintenance. A lot of times there's life safety hazards, which you have to come in and fix right away. Strategic capital infusion. So you take a property like this and we strategically let you know where you're going to spend the money or where to spend the money in the right ways so we can increase your value and increase your rents. We reposition the asset, and there's a huge upside for your value add here. These are the fun ones for me. I love fixing things. You know, as a kid, I used to break stuff just so I could put it back together. Well, now I let other people break it and I come in and fix it. It's fun. On the other side, you have the cash flow maximization. This is where you're going to hold on to your property for a while. We keep your turnovers, your vacancies, your expenses as low as possible. We increase the efficiencies. Rents are kept just below market so that that property looks a little more appealing than the one next door. We're not going to spend as much money, but here the key once again is people. You want to keep your residents at a property like this. We're not trying to generate turnover. We're not trying to renovate a bunch of units. We want people to stay. We want people to be happy. So if we don't take care of those people, if they don't trust the manager again, they're not going to stay. So I went through a few different strategies for rehabs here. And interesting, when you put this together, 3 of these are actually on the same property. So 3 different strategies at one property. So this property right now, the owner's spending about 30 grand on these turns. So every item that he's working on, he's taking it up just one notch. So everything from the appliances up a notch. We've put in the washer and dryer there in the bedroom. In the bathroom, this stylish flooring, quartz countertops. Everything's up just one standard. And I'll explain how this affects the rents in a minute. Same property, different strategy. This one was just before. So everything here is still quality, still good looking turn. My wife prefers the gray theme over the other one. So do I in terms of appearance. But when you look at the property, nothing looks cheap. And we can go down to about $15,000. Same thing. 15,000 is at your mark where, you've got your big ticket items, you've got your flooring and your cabinets. Once you get into cabinets, we're usually jumping up about $15,000 or more. Really depends on those two big ticket items, but you can do a lot for $15,000. This is a good quality turn here and something most people would move into. And then here's your quick turn. This one costs a little less than $10,000. Luckily, even though I think the flooring's ugly, we kept the flooring. Went in, put some granite countertops, quick refacing on the cabinets, but it's just the cheap kind of straight face. But you can see here where those steps that were taken in the other units weren't taken here, except for that last slide. The first one, the second, and this one are all the exact same property. 3 different strategies, 2 different owners. This one, we increased the rents about $300. The $20,000 strategy increased the rents about $500. And the $30,000 strategy, we're getting about $700 more a unit in rents. So far, he's renovated about 15 units at a 5% cap rate. That's about $2.5 million in value that he's raised that property already in about 8 months. Those are the fun things. You just get to come in, fix it up, and make people money. But not only that, what he's doing here at the property, the laundry rooms, got rid of the coin-operated laundry room. It's free laundry. So that few $100s a month that he might take, he turned that into an amenity. It's just become a little hot spot in Long Beach. Also, we'll come back to this, but these are in preparation for the possible rent control coming up. And of course, the exteriors. You can go and do all that stuff on the inside. Fix up the outsides. It's not going to look too good. I don't think this is going to work now. Well, this was a little video, but it's not a little video anymore. That's a bummer. Well, this was a little video of a property in Long Beach that the owner renovated. Rents are about $1,100 more now than they were a year and a half ago at this property. Completely redid the outside, common areas, fire pits, places to sit. It's absolutely beautiful. This was a little drone video I did, and all of a sudden you scroll down, you turn around, and there's this beautiful property right there in Long Beach. And by putting the money in the right places, if this property does end up going under rent control, he's ready. So we take it into rent control. So I'm going to leave all the details of the rent control to people that know a heck of a lot more than I do. Obviously, the basics, we're capped at 3% a year on rent increases. Plus, there's a lot of protections in place for the residents. Most of us here, I think, are pretty well-versed on the rent control, but it's very hard to get somebody out. Right now, we have a lot of owners, which we'll get into also, preparing for rent control. So they're asking people to leave now so they can renovate the units, fix them up, so that by the time rent control gets here, they're not stuck with this. Because unless somebody does something wrong, or the owner wants to move into the unit, you can't get it. It's incredibly hard to get somebody out in rent control. It takes a little bit of work. I'm going to skip the Costa Hawkins. We all know that's kind of coming up for vote, and everybody has their own opinion on that. One of the things you can do at a rent control building, obviously, is it allows the landlords to pass off 50% of the capital improvements back onto the residents. There's certain criteria that involve, but any of those capital improvements, roofing, landscaping, doors, awnings, major appliances, as long as it's a benefit to the resident, it lasts more than 5 years, it's fixed and you can't move it, it was completed within 12 months of the application, and it's not normal maintenance, wear and tear. So when this happens, if a resident's lived there for a year, you can defer 50% of those capital improvements back onto the residents, on top of the resident's rent. And then basically, right now, which everybody's talking about, is rent control coming. I'm lucky to have a great group of owners right now that are really getting prepared for rent control. That nice little video that you didn't get to see is one of those properties where he's positioning himself perfectly so that if rent control happens, he's already ahead of the game. Right now, we have a number of properties where we're asking people to leave, renovating the units, and then re-renting them at much higher rates, $500, $600, $700. Unfortunately, you can't just go in and raise somebody's rent, because if rent control comes in, then they're going to backdate it, and anything above 3%, you're going to have to pay that resident back. So you can't just raise the rents. You can renovate a unit, and then they can move into that renovated unit, but it makes it a little more complicated. Plus, there's little things you can do, smart documentation. If there's a benefit to a resident and you take that benefit away, technically speaking, that resident on rent control needs a reduction on their rent. So there's other things that you can do, things like parking, garage rent, things like that. Make it a separate addendum. It becomes a complete separate agreement from the rent. Then it's not capped off at 3%. If you charge $50 for parking, you could raise that to $250, and you're free and clear there. In the end, though, it all comes down to the people. I've been doing this a while, and I've seen people take the financial shortcuts. It always backfires in the long run. The right people in the right places. One of the things I love so much about Mashcole is that the moment I met Joel, since that day, he has never talked to me as if I'm an employee. I've always been treated as if I'm a team member. And I thought it was really cool. I thought I was like somebody special. It turns out I'm not, because he treats everybody that way. Our entire employee culture is based off of teams. And my employees will do anything for me. I've got about 7 employees that follow me from the last job. Joel has about 30 people, I think, that have followed him from his prior jobs. Julie is one of them. That devotion and the right people, it's not only how we treat our owners, but how we treat our residents, how we treat our vendors. I get great pricing from my vendors because I take good care of them. I don't treat them as if they're there to do my bidding. They're also part of the team. And so training people from the top down with that type of mentality makes a difference like I've never seen anywhere else. It's a pleasure to be a part of it. So if you have any questions, Julia will be taking questions at the end. Correct. Correct. It's a complete separate agreement. It's not your rent agreement. She asked in regards to say parking, if you separate it from the lease, if you could increase parking more than 3%. And just recent conversations with our attorneys, yes. So, what's happening is we're separating all of the parking agreements, the pet rents, things like that. So it's not capped off at 3%. It's not a service that's provided within the lease. It's a complete separate agreement. Good question. Any other questions? All right. Thank you very much.
All right, thank you. The lights. Quick commercial. A quick commercial for Mashcole. Was put under contract, the deal in Long Beach, and I was on the listing side. Buyer shows up at the inspection and says, yeah, there'll be about 10 or 12 people coming to inspect the building. And I was, as a listing agent, I'm like, you got to be kidding me. We're going to be at this 8-unit building for the next 6 hours. Well, Mashcole was the one that was the management company that was inspecting the building, and it was probably the most efficient and fastest inspection I've ever seen. And they were just incredible, and since then I've been encouraging my clients to utilize them as well. They do such a great job. All right, so moving on. Our next speaker, who I've known or met 16 years ago. Super excited to hear from her. Joni is co-founder of Better Housing for Long Beach, a grassroots nonprofit organization created to educate property owners and tenants on the dangers of government ordinances that harm tenants, communities, and housing providers. Joni has been on the front lines of the political, legislative, and cultural fight against rent control in Long Beach and Southern California. With the recent legislation measures and strong forces at work for rent control in our market. We are grateful to have her and her expertise for us tonight. Welcome, Joni.
Well, thank you very much. I'll make it brief. Well, first, I just want to thank Bogie for the amazing hors d'oeuvres. Weren't they amazing? Let's give him a hand. I did meet Bogie many years ago, and I'm actually an investor myself. I'm a property investor. I'm a small, not mom and pop, just a mom investor. And, I was just growing my investments, just trying to make things work out. And then I started I have a property in West Hollywood. Does anyone have property in rent-controlled areas? So you guys, right? So you know the drill. And I have our unincorporated cities. Yeah, we're fighting on that one as well. I saw the warning signs coming to Long Beach because I have property in West Hollywood, and so I thought, boy, we have got to get everybody awake in Long Beach so we don't have rent control in Long Beach. And so I just went on a quest and a mission to start sending out emails to everybody warning them that, hey, this is coming. Because, when you've lived in and owned in rent-controlled areas, you see the warning signs. So we started the journey, and we were successful at shutting down rent control in Long Beach. So let's give ourselves a hand for making that happen. And how we all did it is we did it very grassroots. And I know that there's a lot of groups fighting the statewide repeal of Costa-Hawkins, large groups. But in San Mateo, they shut down rent control by the grassroots efforts. Everybody, the realtors, getting involved, going to the homeowners. And so that's our position is to work hard and getting everybody awake. If you're gonna have property, this is a time, if you're gonna hold on to your property, this is time to stay awake. Because politically, you have to be on top of what's going on. And so for us, we started Better Housing, and we've been educating. We went into the community. The good news that we found of 6-7 months in the community, talking to pretty much everybody out there and convincing them not to sign those petitions, is that more people are in our camp than we realize. We got withdrawals at the colleges, kids saying, wow, I didn't realize rent control was such a negative thing. So education is so important, because if these groups are creating this situation by getting into the communities, wouldn't getting into the communities and giving the other message kind of shut it down? And that's what we did in Long Beach. And I think that we're gonna shut down this repeal of Costa-Hawkins. I think it's not gonna go through, and we're gonna stop it. And I brought every one of you, I think pretty much every one of you, a sign. So when you leave, please put it on your lawn. No, vote no. I mean, it's all that small stuff that really makes a difference. And I'm committed. I spent a lot of time and money on my investments, and I don't want to let them go right now. This is what I work for. So I'm going to just do whatever it takes to protect my investments. And if you're going to hold on to your property, you need to get active, get involved in some form, like whether it's an apartment association. I belong to all of them because everyone's got different information, and so, but the grassroots actions, getting out in the community, explaining the dangers of rent control is really important, and we're going to continue to do that. We're partnering with Dan Fowler. He's having seminars, handing out. We've actually produced their sign for them that they're giving out, and he's the president of AOA. We just spent the whole day at the Apartment Association Southern Cities trade show, handing out T-shirts, bumper stickers, lawn signs, and that's what it takes, is just getting people to fight for our personal property rights, because they're under attack. And But the great thing is if we fight and we all join forces, it protects what we have, and we don't have to, run out and sell everything and leave the industry. A lot of our members of Better Housing got very fearful and didn't think we were going to, shut it down, and they sold really quick, and now they're regretting it. And I just think whenever these activists are masters at manipulation. If you go on social media, you would think that every person is anti-property owners. But the truth is, a lot of the stuff you see on social media is not accurate. And what we experienced out in the field is so different than what we see on social media. So we're positive, we're optimistic, we're going to keep fighting rent control in Long Beach. We're going to deal with Sheila Kuehl. I don't know if anybody knows who Sheila Kuehl is. Does anyone know? That lovely angel? Anyway, she just pushed the freeze, the rent freeze. Thank you, Vicki. And we just found out today that she makes $300,000 in addition to her salary working on the rent board in Santa Monica. So that's a conflict of interest that we need to address. And these are the kind of things that as we share information, all the associations and the organizations, that we can, keep putting the politicians' feet to the fire and stop these ordinances, because they're not going to help. They're not going to help California, and they're not going to make more affordable housing. They're actually going to escalate the housing prices and the apartments. If you look at rent-controlled cities, and this is one thing that really flips the tenants. When I give them information and say, look at the cities that have rent control, they have the highest rents in the nation. And they just go, really? I didn't know that. I said, yeah. And I give them all the cities. Santa Monica, which is where Sheila Kuehl lives, has the highest rent in the nation. And so, and then you look at San Francisco, and all these have the highest rents. So how, if rent control was enacted in 1979, if rent control worked, how did they become the highest rents in the nation? And then when you put that to the people and the activists, they can't really answer. And so then you start to, explain that, hey, this is not the path. And we have given out 120,000 pieces in Long Beach, educational pieces. And we're going to continue to do it. And, if you can't get active, you don't have time. The one problem is these activists, their job is to try to push this stuff onto us. But the reality is that we're working, and if you don't have time, just donate to an organization that you feel confident in is going to really fight this stuff. Because there are a lot of good ones out there fighting this. And stay positive, because we stayed positive the whole time. We had hundreds of people volunteering and getting out in all the communities, and that really works. So I want to thank you for your time. I don't want to keep you here all night, but be confident that we're gonna beat this rent control stuff. So, any questions? Don't ask me something I don't know. No, I'm just kidding. Okay, let me tell you the different groups that are fighting rent control. Now, if you're talking about the local, donate to us. No, I'm just kidding. You can, no. For local Long Beach rent control, Better Housing is a great group to donate to. Small Property Owners Association. Better Housing for Long Beach does more of the grassroots. SPOA does more of the dealing with the politicians. In the areas, you need both. You need to deal with your council members, and you also need to deal with, you need to deal with the mayor, you need to deal with the council, you need to educate them constantly, and that's what we did. We met with the council members, we met with the community. You have to do it all. Apartment Association of Southern Cities has a political action group. Vicki here is on the board there. There's also AOA has a political action group. The groups that are fighting statewide is we have CAA, right? NAA. What's the other one? And Cal RHA. So those are the three that are fighting. We're going to do more grassroots. We're going to go door knocking, things like that. They're not going to do that kind of stuff. They're going to, I wouldn't call it blocking. So let me explain that. I would call it educating, right? Yes, we did a lot of educating. Wherever there was signature gatherers, we set up a table and we educated the community. And so, well, thank you, Vicki. Come on up here. No, I'm just kidding. Yeah, the petition did die. Yeah. Well, we did what happened. Well, okay, thank you. So what happened was we were going to store by store and doing the education. And what happened is we had to continue to change our strategy because then they would try to get us kicked out. So then we created a petition for council members so that we were both now collecting petitions. And then we came up with a back my signature strategy, which meant that we went around to colleges, which we got about, in one day, got 150 college students to sign a take my name off the signature, take my name off the petition. So we did a lot of creative stuff, to stop and block it. But to go back to your question is, though all those groups are fighting it, and if you belong to apartment associations in other cities or any association, donate to where you feel, that the organization and you trust it and you're confident in what they're doing, and ask them what they're doing. A lot of people don't know what to do. And that's why we did quite well, our group, is because a lot of people are kind of frozen saying, what do we do? I said, you got to get out there. If those activists are out on every street corner, we need to be on every street corner, because who's going to give another message? And that's what we did, and that's what we provided. So, a lot of people are working on it, doing different strategies. So our website is www.betterhousing for Long Beach. I know Vicki's going to ask me something else. What were you going to say? Okay. I'm sorry. What? Yeah, Housing Long Beach is a group that's really spearheading local rent control. Yes. Oh yeah. Well, we don't want to share all our things, but anyway, we're gonna let you. We crashed a lot of their fundraisers. That's all I'll say. Is there any other questions that you have? Okay. Yeah. So I'm going to wrap it up, but I want to thank you for your time and keep fighting. If you're holding on to your property, get busy, get active. Show up at council meetings. We're going to have 2 things on the council. If you have anything in Long Beach, they're pushing relocation fees, and they're also pushing. Thank you, thank you very much. Just cause evictions. So I'm going to be sending out an email. So please show up at council meetings, and appreciate your time. Thank you. Vicki's here chatting.
All right, thank you so much. I'm sure you guys have lots of questions. I know we're trying to hold them until the end. So if you guys want to grab a quick drink or use the restrooms are all the way down the end to the right, outside. And then we'll come back for some Q&As. If you can leave your questions on your seats. All right, so we got a few questions, which may open up some more questions for more people. So I'm going to start with these. I don't know, did John? Where's John at?
John Seabury to the stage.
Oh, there he is. All right, so I'm going to, actually, before I start with the questions, there's a few new people added to the panel here. So I'm going to start with let Shane introduce himself. Shane Young.
Hi everyone, Shane Young. Bogie introduced me earlier. Long Beach specialist, and been with M&M for little over 5 years.
And also next to him, David O'Keefe.
Yep, Dave O'Keefe. I started at M&M right out of school back in, I shouldn't age myself, but 92, and ended up leaving, went into the construction field just to kind of get an understanding of construction, and was working on apartment rehabs, which was great, knowledge for me coming back over. So I've been with Bogie for a little bit over 5 years as well, and it's amazing how we've the team's grown and our volumes and the number of deals we've done has been just incredible the last 5 years. So good team, but I work the mid-cities a little bit in Wilmington and San Pedro as well.
All right, and I'll introduce Julia, who's also with Mashcole. Julia is the VP of Operations at Mashcole Management. She has over 25 years of property management experience. Her focus has been on renovation and repositioning of unstable assets in and around Southern California, and she has led the complete turnaround of dozens of properties with average overall rental increases in excess of 20%. So we've got a great panel here. I'll start with the first question that we got, and it's probably aimed towards Joni or John, but anyone else that wants to jump in. It says, what is going on with the 60-day, 6-month rent freeze in unincorporated LA?
Well, it was just enacted, and they have 60 days to write policy. And I did receive a letter from Janice Hahn wanting input. But I would stay, if I were you, send each one of those people an email saying you're very unhappy about the decision, and keep pushing back. And especially let her know that you don't appreciate that there was a conflict of interest with Sheila Kuehl having a $300,000 salary regarding rent control. So that's a conflict of interest. So we're going to pursue that avenue as well. So they're going to be making policy regarding that. Writing policy.
John, do you want to comment on that as well?
I'm aware of it. I'm probably not well versed enough to give an opinion on that.
All right. Next question. As a buyer, why should I reinvest when the market is at its peak, meaning pricing? Do one of the brokers want to answer that question?
I can start. Yeah. So, I mean, depending on the markets you're looking at, as a lot of you know, focus a lot, and guys I work with focus heavily in Long Beach. And just specifically in Long Beach, I mean, it's one of two major municipalities in SoCal where the metro goes to the water, there in Santa Monica. And 78 ground-up developments in Long Beach, and the rent growth has been consistently 7+% a year. And so investing now, it's obviously an investment in your future. And even with cash-on-cash returns, everyone's searching for that double-digit return. And you'll get there, I'm sure. But leverage is the name of the game. And a lot of times we're educating the return on equity and really emphasizing what your current return on equity is and kind of where you can get it with some activity and with some 1031s. And there's a lot of opportunities out there.
Let me jump in on that. There's another perspective to keep in mind, which is if you look at some of the benefits of the tax law that was the tax reform that was passed in January, if you've got a property that you've owned for 10 years, maybe 15 years, you don't really have much depreciation left on that, and or you have some, but it's waning. Your ability to exchange out of that property and go into another property, and I realize what everybody says is, listen, I'm going to sell my property, and I want you to sell it for a 3.5 cap, and then find me one exactly like it that I could buy at a 6 cap, right? It's probably not going to happen, but you might be able to find a property that you can purchase that you can put some additional capital improvements into. And if you look at the new tax law reform and the benefits of the accelerated depreciation and looking at that from I'm going to buy a property and I'm going to spend, the property management company that was up here earlier was talking about going in and spending X number of dollars per unit. And what you've got to realize is that you're going to be able to get a tax benefit not only on the money that you're investing in that, but on everything that you remove from that property. So you could probably, you could effectively sell a 40-year-old property at a 4 cap and buy another 40-year-old property at a 4 cap and dramatically increase your returns. Does that make sense? So there's another side of it that I think sometimes that peeling back a couple of layers of that and understanding some of the benefits of that can create a lot of opportunity as well.
And on top of that, and not encouraging anyone to buy out of state, but we have seen a lot of people that are selling their 3.5 caps in Southern California and actually buying 6 caps in Texas, Arizona. We're under contract on a couple deals in Florida right now, and so they're able to increase that cash flow pretty dramatically. All right, next question. I was pitched a triple net property as an exchange option from a Marcus and Millichap broker, but I am fearful of pulling the trigger. And if the person who asked this question, if they're here, what is the biggest something involved? Risks.
Yeah,
Who asked
I'm
that?
sorry.
we know who
We're,
wrote it.
yeah,
No, just kidding.
we're brokers. That's not even a word that's in our vocabulary.
David, you want to?
Yeah, sure. I was just talking with John over here a little bit about that, and we hear that a lot. There's always a big concern about the triple net. The biggest risk reality is at the end of that lease, the tenant leaves. But what I was mentioning to John is it really comes back to the fundamentals of real estate. You know, you buy a triple net in location. You've got a good solid tenant, so it really takes the management out of it for the apartment owners. And as long as you're in a solid location, if that lease comes due, the tenant's gonna, if they don't want to stay, it's gonna be a pretty easy process to backfill that space.
See, no risk. What impact will opportunity zone designations have on increased property values in those zones? Maybe another broker question? You want to?
Yeah, I
Awesome.
can talk about that
Great.
a little bit. If you look at the opportunity zones, and it's going to be different in each one. So there's two sides of it. One of them is that there is the opportunity zones, and I'm not extremely well versed. I'm going to be able to talk enough to make you think I know what I'm talking about, but I really don't, so don't ask me questions afterwards. But the opportunity zones really create a benefit for, and there's a lot of them, and they're in all 50 states, but they create a benefit primarily for ground-up construction. Because whatever you spend on the property in order to get the benefit of the opportunity zone, you are then going to have to spend at least that much in improvements on the property. So if you have a warehouse building or an office building, it's not that hard to buy an old beat-up warehouse building for $2 million and spend $2 million retrofitting it for a new tenant. But with an apartment building, you almost have to scrape it and build up from there. So I'm not anticipating an enormous amount of benefit to the multifamily industry from opportunity zones. Also, most of the opportunity zones, most of them, not all of them, but most of them are in heavily more industrial areas, because what cities are doing, they designated opportunity zones based upon where they want jobs to come in, as opposed to apartments to come in. The question that you had was, now, how are opportunity zones going to affect the value of multifamily? If you own an apartment building that's up and operating and doing well in an opportunity zone, it's probably going to benefit you. It's probably going to bring in more jobs. It's probably going to it's going to increase the population and allow you to raise rents. Unless you're in an opportunity zone and under rent control, and then I don't know what to tell you.
And the last question that we have here is, how will rent control affect values? And maybe we can just go down the line from everybody on this one.
Do you want me to start?
Sure. Yeah.
Well, in the short term, it's going to be rough. But if you can wait it out, look at the cities that have rent control of the highest rents in the nation: Santa Monica, San Francisco, West Hollywood. What's that? Beverly Hills. So it's just, can you hold on to your property? And so that's why you want to prepare now. If you're going to hold on, get your rents to market, take good care of your building, and get the rough tenants out. You know, that's what I would. So I think short term, not so good. Long term, pretty good. So, but we're going to shut it down, so don't worry about it.
Give me the question again.
How will rent control affect values?
I think, first of all, to put things in perspective, California has rent control. California has the ability to implement rent control right now. What they have is Costa-Hawkins, which puts some guardrails on the regulations they can have with rent control. What Prop 10 does is it repeals Costa-Hawkins and allows the municipalities to put much more strenuous guidelines in place for rent control. So if you are in a market that has never had rent control and has never really talked about rent control, the repeal of Costa-Hawkins, even if you're in California, it may not change things a whole lot for you. I think that if Proposition 10 is passed, I think what happens in the short term, I think a lot of people just kind of hunker down and wait and see, right? It's kind of like when the storm is coming over, everybody's just going to hang on and see what happens and see how it plays out. And it's not as if it's going to pass and the next day everything is going to change. I mean, if you look at the fact that what they're doing is enabling municipalities to create an entirely new branch of government for their municipality that will become the rent control board with appointed decision makers on that, and then they have to create laws that are going to be enacted. I mean, you're literally talking what could be a couple of years, right? So in the short term, people are probably kind of hanging on and just waiting to see what happens. And there's going to be a lot of talk about, well, they may enact rents based upon a previous date, and the frightening part of Proposition 10 is that they give an enormous amount of authority to these small municipal appointed boards. And trust me, nobody on the board will own real estate, right?
That's true.
In fact, they'll probably all be government workers. So, I think in the short term, I think it's going to be pretty tough. In the long term, hopefully we don't have to find out. But I think in the long term, your comment was you end up with the highest real estate values. But the problem, what you've got to realize is that if you are in a Santa Monica or in a Los Angeles and rent control is enacted and they implement vacancy control and they tell you that a tenant moves out and you're not going to be able to increase that to rent, effective what San Francisco right now has is that your rental increases are 60% of CPI, right? So CPI is Consumer Price Index, which means that's the amount that average expenses are increasing every year. So if you do the equation and your income is going to increase at 60% of the rate of your expenses every year, it takes only a couple of years before you're inverted on that. So that's really the long term. So I don't disagree with your comment that many of the properties that are in cities under rent control, whether that's DC or New York or whatever, and again, I'm kind of a national perspective, but yeah, those properties are selling for a whole lot more money. It doesn't mean the owners are making any more money though, right? So I think, and not to disagree with you, but I just think I think even long term, I think what happens is long term, you've got a property that, maybe it increases in value, but are you making any money in the process? So I went off on a tangent there.
And it was good. So.
Good tangent.
I picked a tough seat following John.
Yeah. Hey, good luck with that.
Yeah. Well, one major point, as a lot of you know, and it was previously brought up, is pro forma, right? And we're selling properties on pro forma. People are underwriting properties on pro forma. Rent control immediately affects the pro forma and the upside in the deal. And so that, I mean, and if you look at rent control markets, like someone mentioned Beverly Hills, and we've sold deals in rent control LA, Hollywood, et cetera, and there are certain buyer pools that are well-versed in controlling that type of tenant and turning those units and really adding value. But I think where it immediately affects value is markets where there isn't rent control and then it's implemented. And the buyers who are usually active in those markets are all of a sudden in an environment that they don't understand and don't know how to handle. And for that reason, I mean, a real life example, a client of ours that was here this evening, we've done probably 10 plus deals in the last 2 years with them. For about 6-month period, they were just totally out of Long Beach because of all the rent control rhetoric, and they just weren't a buyer anymore in Long Beach. And so with that kind of rhetoric being pushed and less eyes looking at deals, it makes it tricky. But there's a lot of ambiguity to it, and hopefully we beat it.
So obviously we don't have a crystal ball to know exactly what will happen to the prices, but the way I look at it is, and I handle a lot of the mid-cities area, Downey, Paramount, where there is no rent control currently, and we're getting north of $200,000 a unit for those deals. And then I do a lot of deals in San Pedro where there is rent control, and it's a very similar demographic area. Market's pretty similar except for the rent control factor, and those were not hitting $200,000 a unit on it. So there's definitely a discrepancy in price. So will rent control affect? I think Shane nailed it. In markets where there hasn't been rent control, yeah, it's going to create some kind of turmoil for a little bit, and I think there will be some reduction in pricing.
Julia, do you guys want to comment on that?
I'm going to touch on something that we haven't talked about yet. Is in rent control, you get to pass off part of your capital improvements back to the residents. That will assist a little bit in offsetting some of the rent problems that we're going to be looking at. You will be able, anything that you've done to improve your property, you get to pass it back off to the residents at 50%. 5 years. 10 years. It's 5 years. 60 months. It'll help a little bit. How many percent? 50%. I'm sorry? Oh, I was saying that with rent control, unlike non-rent control, you do get to pass off part of your capital expenses to the residents. So any capital improvement that you have, whether you've added a gym, you've put on a roof, you've changed the windows, all of those expenses, 50% gets passed back to the residents. So that will help you recoup some of the cost.
So if I modernize their kitchen, I would do 50% on their rent?
No, it has to apply to all the residents. It has to be a capital improvement. Yes, exteriors, not interiors.
Go ahead.
If CapEx is, if the tenants are on a lease, can you still pass that CapEx to tenants?
No, this applies to anybody that their lease is expired.
Which is usually how many of those people, the majority?
In rent control, almost everybody's on a month-to-month.
But let me ask something, and I'm just curious, and I'm the person that's not from California, so I'm just making it up as I go along. But my understanding of Prop 10 is that what you're reciting are the current rent control laws that are in place right now. Correct. Once Prop 10 comes in, all of that's wiped out. They can start over. They can create entirely new laws that are totally different from that. So we don't know for sure that the laws that are in place right now in a given municipality are actually going to be in place moving forward, do we?
No, it's an assumption. We expect it to follow the current rent control laws.
But we don't know.
No, we don't. We do not know.
I mean, that's the one thing about Proposition 10, is that it gives the authority to create their own rules to every single individual municipality. So each individual municipality could come in and say, yeah, we really don't like that. And in fact, what we're going to do is we're going to tell you you have to make capital improvements, and then we're going to tell you, in addition to making the capital improvements, we don't think you should increase your rents. I mean, it can go a million different ways, but if Prop 10 is passed, that doesn't necessarily, we can't necessarily assume that the existing laws would stay intact, correct?
That is correct.
And I'm not trying to create dispute. But
Oh, no, it's a great conversation.
That is correct. You have to prepare for anything.
And do everything we can to make sure it doesn't pass.
Also, on top of that, I'll quickly introduce Michael Dirk, who's sitting over here. He was with Marcus Millichap Capital Corp, and kind of just tying the values into what lending looks like on a rent control building versus a non-rent control property. If you want to maybe just make a comment on that.
yeah, now that we've created a dispute up here, Michael, why don't you go ahead and join the conversation?
All right, it's a little impromptu here, but yeah, the impact of rent control versus non-rent control with lending, the one thing is we all know that lenders overreact. So if this rent control does go into place, I think the swarm of lenders that might step back from the market to see what happens, that's a big concern that a lot of people and a lot of our clients are really considering right now. And with rent control, we don't see pro forma. Lenders right now give benefit of the doubt if you can raise rents. A lot of the deals we're working on right now in escrow, you can raise rents during escrow, and as long as those rents are in place at closing, they'll underwrite that income, and we get a lot more loan dollars. Now with a rent control property, that's going to have an effect there. So hopefully that kind of addresses it. So you have to be proactive and think about it. If lending changes and the capital markets change on properties, that drastically could affect value in a lot of different ways. So just something to think about.
Sorry, the 10-year was on seismic retrofit. We just did a seismic retrofit in LA. Do you see that spreading? We did a seismic retrofit in LA, and that was a 10-year capital improvement on 50% of that. But do you see that spreading to other municipalities in the future?
Well, it is spreading right now to West Hollywood. It is spreading. I mean, I have a property in West Hollywood, and I just got paperwork on it, so I'm seeing it spread, yes. I don't know if you have any...
Yeah, no, it's definitely spreading. I mean, Wilmington's doing the same exact thing. San Pedro's doing the same exact thing, so it's definitely spreading.
Jeremy, Julia, you probably are seeing it too.
My name's Jeremy. I'm an alcoholic.
Hi, Jeremy.
Wrong room. Sorry.
Oh, wrong room.
I mean,
Hello, Jeremy. Oh, sorry. I was there too.
I think the word prepare was used. And it's, I'm not a broker. You guys are a heck of a lot smarter than I am. And on the ground, I've seen a lot of owners that in our portfolio, start to prepare for this. And if we can get the rents in place properly before all this comes, then by the time rent control gets there, we're already going to be ahead of the market. But for those properties that haven't prepared, that's where the damage is going to come.
Are you guys seeing the retrofit moving into other areas as well?
Yeah, I have one in Whittier right now.
Whittier and Downey.
Yeah.
All right, any other questions out there? I saw some other hands.
So if rent control means the rents rise, like San Francisco, Santa Monica, what is the biggest downside for the buy and hold investors?
You want to?
If you already own it or if you choose to buy it moving forward.
If you already own.
I think the biggest concern, and again, it's such a crapshoot because every single municipality could essentially sit down and make up their own rules and create a whole new branch of government. But the concern is that you own a property in a municipality, they implement rent control and they implement vacancy control, and over a 7 or 8 year period, your expenses increase at 2.5% a year, and you're only allowed to increase your income at 1% a year, and you end up in a bad spot. I think that's your biggest concern. What do you guys, anybody else?
So Prop 10 sucks?
Really sucks.
Yeah.
Can I get the perspective of Ms. Weir?
Oh, I'm sorry, was I supposed to be quiet there?
No, no. I think, well, it's similar to what you said. If you look at when it was implemented in Santa Monica, a lot of our members of Better Housing owned in Santa Monica when it was implemented. And what happened was, you've got expenses going up, and then you've got, you're capped on what you can raise your rents at, and then the city puts on another bond, and then they put on another bond and another bond, and you keep, so you're you're basically the same thing, you're going upside down. So it's really important that's why it's important to be politically active and aware and vote down some of those ordinances that they want to push through and be active, because one of our members, one woman took on the water board in Long Beach and won. And now everybody in Long Beach is getting a rebate for their water for years that the city she sued the city. And so one person can do amazing things. Has anyone ever heard of a woman named Nancy Allswede in this room? Okay. Well, Nancy Allswede kept rent control, one woman, out of Long Beach for 30 years. In 1979, rent control was swooping in on like everywhere, Santa Monica, all these. She said, it's not coming to Long Beach, and she stopped it. And she has kept it out for years. Nancy just passed recently, but she mentored our group and told us what we needed to do to keep fighting. And so imagine if every person that invests in real estate, every person that works in the industry, all fought. And, that's a lot of power. And that's many Nancys. So I believe that if one woman can shut it down, all of us can make differences and changes. And you have to remember, how does something get so bad? It's because people let it get bad. You know what I mean? So we have to be active in who we, be very cautious who you vote in. Make sure they're pro your industry, because some of those people, are going to push ordinances that are going to be very harmful for us. So I think that we just have to make sure that we don't go upside down, and by keeping your rents to market, being diligent, staying active with the things they're starting to pass. A lot of stuff they're pushing through quietly. I don't think anybody in this room knows that Long Beach is trying to pass, relocation fees quietly behind the screen, the scene. They're also trying to pass just cause and 3 other ordinances, but we're behind the scenes fighting it right now. And hopefully we'll beat it too. And they're going to vote on either the 23rd of October or in the middle of November. So show up to the council meeting and fight with us. So hope that helps.
All right, any other questions out there? That might just do it then. Awesome. Thank you guys. Thank the panel for coming out tonight. I really appreciate it. Thank you guys for attending. Really appreciate that as well. And look forward to talking to you guys afterwards. And the bar's still open.
Hey, let's give Bogie a hand for an amazing event.
Thank you, Bogie. The food was fantastic.